HBAR and XDC is officially taking over. XDC and Hedera Hashgraph holders must watch this video. They laughed at HBAR. They ignored XDC. But now, the institutions are moving in. The real-world use cases are here. And the silent accumulation has already begun. HBAR and XDC are no longer just speculative assets. They're infrastructure plays. Real-world adoption is underway, and the writing's on the wall. Government-backed pilots, enterprise-grade integrations, compliance-first architecture, and billion-dollar fund involvement are becoming the new normal. These aren't altcoins you trade on a whim. They are strategic pillars of the emerging digital economy. This video isn't about hype. It's about facts. If you're holding HBAR or XDC, or thinking about it, this breakdown could literally change how you position yourself for the next cycle. You're not late. You're early, but not for long. This is where the smart money is heading, and you're about to see exactly why. Subscribe now. You'll want to watch this all the way through. Let's zoom out and get a clear picture of where HBAR and XDC fit into the broader market, because context is everything. While Ethereum and Solana dominate headlines with their flashy DeFi projects and ever-expanding NFT ecosystems, the real infrastructure for institutional and government-grade applications is being quietly built on Hedera Hashgraph and the XDC Network. These two protocols have chosen a completely different path, one that avoids speculation and instead targets real-world adoption, compliance, and integration into global financial systems. Hedera Hashgraph is not a blockchain in the traditional sense. Its unique consensus model, Hashgraph, enables massive throughput, security, and fairness that's drawing the attention of some of the biggest companies on the planet. Its native token, HBAR, fuels a network that is governed by the Hedera Governing Council, an exclusive group that includes names like Google, IBM, Boeing, LG, Dell, Deutsche Telekom, and others. These aren't just partnerships in name. These entities run nodes, vote on network decisions, and invest in the ecosystem's growth. Hedera wasn't designed to be just another Ethereum clone. It was built to be the industrial-grade backbone for digital identity, tokenized assets, verifiable credentials, and financial systems. Meanwhile, the XDC network, developed by XinFin, has laser-focused on solving one of the most critical and underserved problems in global finance, trade finance. XDC's architecture is a hybrid blockchain, a combination of public and permissioned ledgers that allows it to meet strict regulatory standards while maintaining the transparency and security benefits of decentralized technology. It is fully ISO 20022 compliant, which is more than a technical checkbox. It means XDC is equipped to interface directly with SWIFT, central banks, and regulated financial institutions. It's also deeply integrated into TradeFinex, a platform that digitizes trade documents and unlocks liquidity for SMEs around the world. While other chains fight over retail investors and meme token pumps, Hedera and XDC are attending central bank roundtables, submitting proposals to international standards bodies, and collaborating with traditional financial entities. These networks were not built to chase virality. They were built to solve trillion-dollar problems. These aren't meme tokens. These are compliance-first, institution-grade blockchains that solve real problems and are positioning themselves as the foundational layers of the next financial system. Let's look at what's actually being built, because it's one thing to promise innovation, but it's another to deliver tangible use cases. HBAR is already in the hands of major corporations and being deployed at scale. Avery Dennison's Atma.io platform is one of the most impressive implementations. It's using Hedera to track billions of products across the global supply chain, from origin to shelf, creating immutable records that improve authenticity, sustainability, and transparency. This isn't theoretical. It's already active in over 20 billion items. Then there's LG, a household name in electronics, which launched LG Art Lab, an NFT platform built directly on Hedera. Unlike the noisy, speculative NFT marketplaces on Ethereum, this platform is designed for corporate-grade digital collectibles, tied to curated experiences and user-friendly access through LG's smart TVs. This shows how Hedera is merging blockchain into consumer products without the friction. Meanwhile, Hala Systems is using Hedera for a far more serious mission: crisis detection and emergency communication in conflict zones. By logging critical information on Hedera's ledger, The system ensures tamper-proof alerts and incident reports, demonstrating how DLT can save lives. On the governmental side, Hedera is actively involved in central bank digital currency, CBDC, and stablecoin exploration. Its partnership with MTech has led to test pilots that aim to bridge central banks and fintechs, creating sandboxes for compliant innovation. Hedera isn't just talking about regulatory alignment, it's building with it baked in from day one. XDC, on the other hand, has carved out a dominant position in the trade finance sector, a market notoriously behind the times. Through its flagship platform, TradeFinix, XDC enables digitization and tokenization of financial instruments like invoices, letters of credit, and bills of lading. These instruments power global commerce, yet they're stuck in the paper age. With XDC, they're becoming digital, liquid, and interoperable. XDC is also partnered with the International Trade and Forfaiting Association, ITFA, which includes major banks and trade bodies around the world. Through this alliance, XDC is actively working with the TFD initiative, an effort to transform trade finance for SMEs by using blockchain-based tokens to represent and fund real-world trade transactions. This isn't just theory, it's already happening, with live transactions settled using XDC infrastructure. When it comes to developer tooling, both ecosystems are moving fast. Hedera's Smart Contract 2.0 framework introduced full Ethereum Virtual Machine, EVM, compatibility, meaning developers can build using familiar tools but deploy on a more efficient and secure ledger. This lowers the barrier for Ethereum-native projects to migrate or expand to Hedera. XDC has taken a similar approach by supporting Solidity and other Ethereum standards. Developers familiar with Ethereum can start building on XDC with minimal friction, but they gain the benefits of lower fees, faster confirmations, and a regulatory-friendly architecture designed for enterprise. In both ecosystems, growth isn't driven by hype or speculative cycles. It's being driven by institutional onboarding, government participation, and developers building tools that solve actual, multi-billion-dollar problems. That's not just development. That's transformation. Let's look at what's actually being built. HBAR is already being used by major corporations. Avery Dennison's Atma.io uses Hedera to track billions of products across the supply chain, ensuring authenticity and traceability. LG has built an NFT platform on Hedera called LG Art Lab. Hala Systems uses the Hedera network for real-time crisis detection and emergency communication systems. And most importantly, Hedera is involved in CBDC and stablecoin exploration with partners like MTech. XDC has also carved out a unique niche in the enterprise world. Its TradeFinix platform is designed for real-world financial instruments, like invoices, letters of credit, and bills of lading. It's partnered with the International Trade and Forfaiting Association, ITFA, and it's one of the few projects actively working with the TFD initiative to make trade finance accessible for small and medium enterprises, SMEs. Developer ecosystems around both chains are growing. Hedera's Smart Contract 2.0 framework brings EVM compatibility. XDC supports Solidity, meaning Ethereum developers can easily port over. In both cases, the projects are being built not for the next hype cycle, but for sustainable long-term growth. This is where the real value lies. Tokenomics isn't just about max supply, it's about how the token circulates, accrues value, and incentivizes network activity. HBAR has a max supply of 50 billion tokens, with around 35 billion already circulating. Network fees are paid in HBAR, and staking is enabled through a proxy staking mechanism. Importantly, the Hedera Governing Council, composed of global enterprises, helps determine the token economics, including inflation schedules and ecosystem incentives. This gives it a level of structured, coordinated growth that few other projects can match. XDC has a total supply of 37.5 billion tokens, most of which are already in circulation. It's used to pay gas fees, participate in staking, and operate validator nodes. One standout feature: transaction fees are negligible. That's by design, because when you're talking about digitizing trillions of dollars in trade finance, high fees simply aren't acceptable. In both cases, the token value is tied directly to real utility, not speculative trading. That's a massive distinction. What's coming next could be even bigger. For HBAR, several key catalysts are on the horizon. There's the potential partnership with BlackRock via Arcax, which could open the door to tokenized fund products on Hedera. The Hedera Foundation is deploying a $5 billion fund to accelerate ecosystem growth. And there's increased interest from governments exploring CBDCs, with Hedera positioning itself as a platform that offers finality, compliance, and reliability. For XDC, the traction is equally impressive. The TFD initiative continues to grow, gaining attention from the World Trade Organization. The network is expanding its node operators and working on the DCIP interoperability framework. More importantly, it continues to secure regulatory clarity in key jurisdictions by staying ISO 20022 compliant. This makes it uniquely suited to integrate with legacy financial infrastructure. These are not moonshot announcements. These are fundamental shifts that could catapult both tokens into the upper tier of utility-driven assets. It's not all upside. Let's address the risks. HBAR faces criticism over its centralized governance. The patent on Hashgraph prevents forks but also limits decentralization. Some also argue that Hedera's council-driven model feels more like a corporate consortium than a Web3 protocol. That said, this structure also ensures long-term support from enterprise stakeholders. XDC struggles with visibility. Despite having strong partnerships and working tech, its marketing reach remains limited. There's also regulatory uncertainty around trade finance digitization, especially in emerging markets. Additionally, while its hybrid model is powerful, it introduces complexity that can deter some developers. But these are growing pains, not death knells. Both ecosystems are maturing rapidly, and their strategic focus on compliance makes them more resilient than most altcoins. This is where the real thesis comes together. Several global trends are pushing the adoption of enterprise-grade blockchains. First, we have the tokenization of real-world assets. Real estate, debt instruments, and commodities are being represented on-chain. BlackRock, Citi, and JP Morgan are all experimenting with tokenized finance. Second, central banks around the world are moving towards CBDCs and are looking for platforms that offer interoperability, speed, and compliance. Hedera and XDC are already positioning themselves as solutions. Third, there's a global realignment of trade, including the de-dollarization trend and a growing need for trust-minimized cross-border payment systems. XDC, especially with its ISO 20022 compliance and trade finance integrations, is well-positioned to capitalize on this shift. Finally, ESG concerns are making low-energy blockchains more attractive. Both Hedera and XDC use significantly less energy than proof-of-work chains like Bitcoin or even proof-of-stake chains like Ethereum. Let's talk numbers, but let's be realistic. HBAR currently trades around 8 cents. With growing adoption in areas like tokenized real estate, NFTs, and enterprise data, a conservative target of 30 cents is reasonable in a strong bull market. If it captures a portion of the CBDC or tokenized finance infrastructure, $1 to $3 is not out of the question. XDC is currently hovering around 4 cents. If it continues to grow its footprint in trade finance and gains broader exchange listings, 20 cents is an achievable near-term target. If the TFD initiative scales globally and regulatory clarity solidifies, $1 or more becomes possible, especially if institutional investors begin acquiring the token as part of real-world asset tokenization plays. Remember, this isn't about hype cycles. It's about building and owning critical infrastructure. HBAR is building institutional-grade infrastructure for finality, governance, and trust. XDC is revolutionizing trade finance with a compliant, hybrid blockchain. While the broader crypto space is distracted by hype coins and speculation, these two projects are quietly laying the rails for the next generation of financial systems. They are not trends, they are tools. And if you're early, the upside isn't just speculative, it's structural. Now you understand what most of the market doesn't. And that gives you a critical edge. Subscribe to Be Crypto Smart and hit the notification bell. Because this isn't the end of the story. It's the beginning. The future is tokenized. And HBAR and XDC are leading the way.